Hello folks, welcome back. This is our weekend edition for the ICT Mentorship weekend review. This is our first installment for the month of August. My, oh my, how time is flying by. This is our economic calendar for the week to come. As you can see, it's rather sparse in the sense that there's really not a lot of medium impact to high impact news drivers. And you can see the settings real quick. This is what I have. This is what I have every week. We're focusing on Euro, GBP, and dollar. I don't use any low impact news events. I only want medium impact, high impact, and I also leave this up here for non-economic just because it's habitual for me to do it. So here's what we have. You can see right away there is an absence of any real news on Wednesday and Thursday. And Monday, going into the week, London Open, we have Services PMI, medium impact for GBP. New York Open, 10 a.m., dollar index. We have ISM non-manufacturing PMI. On Tuesday, the only driver to speak of is during the noon hour. We have a speaker, medium impact for FOMC. Really a nothing burger there. And on Friday, GDP, high impact for cable at 4:30 a.m. at London Open. Manufacturing production, GBP, high impact, and preliminary GDP, high impact for GBP. And New York Open on Friday, we have core PPI for medium impact for the dollar index. As a reminder, okay, the economic calendar is just to anticipate when there's going to be periods of extreme volatility. The central banks use these specific times, these days, and these reports as smoke screens. The things that you most likely would expect to see happen in price, or people that try to forecast what these events by quote-unquote fundamental analysis. Just look at last week's, for example. You can't, and it's basically, I'm just going to say it right there, you can't predict the outcome of the fundamental news drivers. I don't say what I think is going to happen. You never hear me say, I think this is going to cause. None of that ever comes out of my mouth regarding the economic calendar. The economic calendar is just a roadmap, if you will. Okay? Or kind of like when the military lays a landmine field out ahead of wherever their coordinates are. Okay? They will draw a map out where these landmines are, so everyone with that map can safely navigate through and not get harmed. This is that map, okay, for price action. This is how I interpret it. So we want to be aware at these specific days, at these specific times, there's going to be manipulation. Okay, that's the only thing I'm really focusing on when I do the economic calendar. Otherwise, it's of no importance, period. Last week, you can see the result of FOMC, and what would have normally been interpreted as seeing the dollar do this or that, and the market's responding as A versus B, it went completely opposite to the direction that the general consensus would have expected. Look at Twitter, you'll see people are asking, why did it do that? Shouldn't it have done this or that? Everyone out there that tries to predict the outcome on fundamental drivers or economic calendar releases for data, that data is just being provided to you, the public, after it's already been interpreted by those in the know. So the only reason why we even bring this up and talk about it on the weekend edition before the new week starts is because I want you to be aware that these are highly sensitive times and days. Anticipate manipulation, and if you get that manipulation, sometimes that could provide you a new setup or justify reasons for completely collapsing the trade. Okay, so there's a lot of new members that just came in. I know you're probably going to ask me a lot of questions pertaining to this calendar. We do it every single week, and again, look at the examples in the past, and you'll see there's not a whole lot I talk about in terms of what the expectations are. Like, for instance, the ISM non-manufacturing PMI. If you go to forexfactory.com, which is the economic calendar I use to show all of the weekly reviews. I think they have a really good calendar. The little box here, if you click, or a little, it's supposed to be, I guess, a manila folder. If you click on that, it'll give you details over here. Okay, and this is the box that I like to look at here. The why traders care about, and then the usual effect. These two, why traders care and the usual effect. This right here, I think, is the number one reason why people lose money trading fundamentals, because they want to see, for instance, like if this number comes out better or higher than the forecast number. Now, what's the forecast number? The forecast number is 55.5. The previous report on this economic news driver was 55.1. Now, right away, you're probably already getting bored. What is this all about? You don't need to worry about any of this stuff. Never worry about it. Don't concern yourself with it. Period. End of story. Because if you were to go back and study these usual effects, they don't really hold up well. They're just not there. So I don't know what the sample size data is that comes with this definition of what the usual effect is going to be relative to the report. The actual, when the report comes out, this will update and it'll be whatever the number is. Trust me, it's not important. Don't ever worry about these numbers. It's not important at all. So again, just to save myself a lot of answering of that question, that's the reason why I'm not answering your email, because I just gave it to you. Okay, so the only importance we focus on is medium impact, high impact, and for the pairs that we trade. Dollar, not that we trade the dollar index, but we use it for a barometer. Are we bullish or bearish relative to the intermarket relationships between dollar and British pound and euro? Okay. All right, so let's take a look at the technical charts and get into this. We're going to go over to barchart.com and we're going to start there. Okay, so we're looking at the dollar index. This is the cash price for the US dollar. And this is a weekly chart, so it's showing the last 3 years worth of weekly ranges. And this is that weekly SIBI. Okay, so the SIBI is a sell-side imbalance, buy-side inefficiency. And whenever there's a period where there's price only delivered on one specific range, and the range is defined by this candle's low or open, and the low is 98.59.9, which is the same as the open. So we're basically going to say 98.60, and then it's defined by the remaining up candle here, 97.87.1. So that's the 2 periods of range that we're looking at. Before this candle, it would have been just this candle's high. Then the next candle, it went up a little bit more, closing in this range. Everything about price, we look for it to rebalance. Okay, so one of the things you're going to learn over periods of time spending with me and my concepts is that your eye is going to be trained to go to specific price points in charts. Okay, so one of the things that you're going to also appreciate is the things that I talk about aren't necessarily in charts. It's what's outside of the chart. Because charts by themselves do not move price. Indicators don't move price. Okay, buying and selling doesn't move price. Okay, IPTA, interbank price delivery algorithm, is the 100% catalyst. Okay, the real reason why the market trades where it goes. Okay, if you asked someone that owned a nutrition store, okay, the nutrition store owner sets the price. Now, that price can be raised and lowered by the store owner. You can only do transactions in that store for that particular product if you're willing to pay that specific price. So again, it's the same analogy. We go through this all the time, but there's a lot of folks, especially new students that come in and folks that are just being exposed to me on social media by way of Twitter or YouTube, they don't subscribe to that right away and it turns them off and they walk away. And that's fine. I'm not going to convince everyone, but that comes with it. You will see over time studying it that it's 100% manipulated. Because if the market was completely random, okay, we wouldn't see these signatures in price. And if it was all about buying and selling, then it would basically say that the things I'm teaching in reference to where the time and price concepts lead price to go to, if the statistics are right, 90% lose their money, then how is it that the market always trades to these price points? By randomness? Someone knows it. So, again, it just leaves someone in that conundrum that, hey, either it's 100% manipulated or it's a random market. I'll leave it to you guys to decide which one it is. I'm not going to twist your arm, but I think if you study the facts and the statistics that I show behind everything I give you, it's not traditional support and resistance. It's not traditional technical analysis. It's not anything out there except for 180 degrees against what is taught. Okay, so when we look for things in charts, okay, the absence, what's missing in the chart here? It's not in the chart. What is it? It's the delivery between this candle's high, 97.87, back up into the low of this candle, 98.59. Okay? So from this period, price was only offered going down. Over here, it went up a little bit into that range. It went a little bit higher here, but left this little portion above these highs up to the old candle's low here. That was unbalanced. Okay, it needed to be rebalanced. It did that this past week. We traded up to it, and then we expanded up into the mean threshold of the last up close candle, which is a bearish order block. Split this range in half. Here's the high and the low. And look at the body of the candle. That's how we do mean threshold. We don't use the wicks. If there's an extended wick like this, we focus right on the body. Okay, and you'll learn about that more when we talk about order blocks. And I'm not done for the charter members. You think you've learned everything about order blocks. There's so much more to talk about. But whenever we look at the body, okay, we focus primarily on the body when there's a lot of wick. Now, if we're looking at ranges for the week or the daily dealing range, then we will use the entire wick because we're dealing with a specific range. But when we're looking at targeting for buys and sells, shorts and longs relative to the order block or the candle that would be classified as an order block, then we look at the bodies. Okay, and it means between the open and close. Here, we're looking at this small little blunt, heavy weighted to the end of the lower end of the candle, and there's a lot of wick on the upside. So your eye should go to the candle's close and open. So the open is 98.59, we'll call it 98.60, and then the close is 99.25. Take that range, divide that in half, and then add it to the open, and that'll give you the price that's being shown here. And I'll give you what that is. Okay, it's 98.92. That's the range middle, okay, or the mean threshold. And we trade up into that by a point, not even a full point, 93.2. And that was the weekly high. Okay, so if we close in this range, the next PD array, which you'll learn about in mentorship core content, is the bearish order block, then the mean threshold, and then we have this area over here. For those that were listening to the video, and I did not show you a chart, I told you to go back and look at your charts or go back and look at the old videos. The volume imbalance, I said, which would be the next area of importance for the weekly dollar index, is right in here. It's this area right there. Now, you can see that there was a candle wick, or in this case, tail, and then we have a wick on this candle, and then we have another higher wick on here, another wick in here. What is missing in the chart? Any bodies. Yes, there's wicks, and they pass back and through here, but it's a volume imbalance because there is no candle in here representing a closure of this range between this candle's close, which is 99.25, and this candle's close, which is 99.97. So there has to be some body, preferably because we're under it now. We want to see a body on the expansion on the upside into this range. So that would be the next area I'm watching. Which leads me to where we're at right now. We have waited for such a long time for this area to get closed in and rebalanced. So it has been. Now it becomes a waiting game. What do we do? Bring in the fact that we're in August. August is the only month in the calendar year in the United States that there isn't really any formal commerce holiday. For instance, like Halloween, it's big on selling candy. And November's Thanksgiving, so there's a lot of money spent on that. December, that's Christmas. And January, New Year's, and it goes on and on and on. But there's really no holiday, commerce holiday for the U.S. where they want you to specifically deal with buying something around some traditional spending. It's a model for creating monthly sales, in my opinion. But there's no real holiday in August. And that's the month that you're designed or trained to go out and spend your money vacationing. Okay, so because of that and because of traditional tendencies in the marketplace, you're going to find that August is a rather... I've had some really good months in August in the last 27 years, and I also mostly had really bad months in August. It's the dog days of the summer. As you can saw in the economic calendar, we have 2 days where it just really isn't a whole lot. And in the days we do have economic news events, there isn't a whole lot of them. So just be mindful that we're in a period where it is going to be frustrating for you if you want to be finding highly liquid, low resistance liquidity run setups in the marketplace on higher time frame moves. You just got to wait. We're getting ready to go into the fall. Really, really easy time of the year where markets are just so easy. They're ripe for the picking. We go in, we find what we were looking for, and it's done. We walk away. And it sounds like an oversimplification, but it really is like that. So where does that leave us? Mindset-wise, looking at the market, we want to know that probabilities are not set for continuation higher or a reversal yet. We're waiting. We want to see how the first week is digested. In trading for August, we want to see the real full week, rather, because we just had Thursday begin the month of last week, and we have non-farm payroll behind us, and it really was a lackluster showing in terms of price action. I think because of FOMC last week, it was what's non-farm payroll going to do now after a big move we saw in cable and dollar explode on the upside. So the focus for this week, you want to be focusing on what we do with this range. Do we leave this shaded in area here? Even though we've closed it in, we want to see, is there an opportunity for it to find some support in here and expand further? And if it does, we want to see it trade up in here. Now, I'm going to give you some of the reasons why, if a gun was held to my head, I think that that's probably likely to occur. I'm not trying to, and like I've done in the past, been very clear and say, okay, we're going to see price do this, and I'm focused on one side of the marketplace. I'm about 60% bullish still dollar, 40% waiting to see if there's something that would break down this week. Now, if we break down in dollar and close in the weekly range fair value gap on this candle here, the high is 97.44, so we'll call it 97.45. If we trade outside of the 97.40s and we get underneath that, then we'll probably make a run for the liquidity resting below these relative equal lows. And then the discount PD arrays on the daily chart for dollar index, they'll be the focus that we've had in our charts for the last couple weeks now. If we come down and close this in and create some measure of bullishness on the upside, then I'll be looking for this area to be the upside draw on liquidity. So I'm waiting for more information. You've seen me do this. You've been with me for a couple months now. If you're new, it sounds like, oh, come on, this is wishy-washy. You don't know, you know what you're looking for? I know what I'm looking for, and it'll be obvious when it shows up in the chart. But right now, I'm just giving you the framework, the bones behind when I have a bias that makes it high probability, and that's why I'm in a 90% in terms of what I expect to see happen every single week. Does not mean I'm going to have it at the beginning of the week on the weekend. That's how I said we have to sometimes wait for more information. But when I get it, I share it with you, and then we know what's going to happen. But for now, just know that we're in between two schools of thought, bullish or bearish on the dollar, because this, I'll be honest with you, it could have topped the market in here and then we could see it trade lower. It can do that. I'm not stating that because it goes against the primary long-term trend that I've been bullish since over here in 2018. So if we are bullish longer term, then I'm going to be very reluctant to put a lot behind a short position that's basically a bearish trade against the dollar index. In other words, I'm not going to be highly leveraged on a long GBP USD trade or highly leveraged on a Euro USD trade that's long. Okay. I would be more inclined to put my full risk parameter and boundaries for equity on a short position still on GBP USD or Euro USD because of the factors I just mentioned here. Remember, we do not try to pick tops in bull markets. We don't do that. We look for levels we can reach for and then continuously identify if there's signatures supporting that bullishness still. If we start to see these bullish signatures be broken, and then every bearish scenario that would be looked at as a scenario for selling short, if they're supported in price, then we know that there's probably an underlying shift in order flow, and then we have to get in line with that. But I demand a whole lot for me to change from a long-term perspective. And it's fine. You can still day trade, counter long-term trend. But I know some of you really want these long-term perspectives. And these are the things that you go through. It's like one of the processes that we use here. All right, so let's take a quick look at the British pound. I'm a little bit out of order today, but I just want to go through these weekly charts and provide some long-term perspective because it's been a while since we reviewed the COT data. And if you look at this is a September contract, delivery contract for the futures market for a British pound. So it's not a Forex chart. It's the actual underlying September contract for the British pound futures market. I like these equal lows in here. I think that that's still going to be a draw on liquidity. Now think about what I showed relative to the dollar index. We have these equal lows here that could still close in with a drop down on British pound here. Now, it doesn't have to go down here. This could be the real low here because we went lower than that one. Higher low here, and maybe we just came down, falsely broke this one, and then it can send it higher, and the dollar does rally. That's what I'm saying. I'm 60% still long-term bullish dollar. 40% I'm waiting for evidences to support maybe we did top. I'm not trying to go out on a limb and tell you that we've topped on dollar yet, but I'm giving you some of the things I weigh in my mind internally and what factors would lead me to believe one side or the other is better at that time. But right now I'm still primarily bullish dollar, which would indicate that I would think that this is still highly probable for equal lows to be taken out. This is long-term support in retail thinking. Okay, so it looks like it covered a lot of ground last week to get us real close to this, and whatever happens this week would lead to either a run below here or setting up the very next week to get a run below. So again, it's a wait and see what we get in the charts right now. I think that would be the favorable outcome for long-term perspective. And that would also, between the range that's existing between these equal lows and where we're at right now on the British pound, go back to the dollar. If you expand up, and that takes us right up in here, that volume imbalance. So if we get to this area here on the dollar index, that should be at the same time, this would be dropping down below these equal lows. Okay, and I think if we trade below these equal lows and then rally up back inside of the range of this low, in other words, we go below these lows and then trade back above these lows, then we could probably see a pretty eventful rally on the upside, then attack the buy side liquidity here. Now, again, that's a lot of forecasting, and I said this stuff in the past, and people say, oh, well, you said. No, I'm saying these are potential scenarios that could lead to future setups. So that's what I'm saying. I have 60% still long dollar in my head. And this is the periods where it's very hard as a mentor, as a teacher, especially for folks that pay for understanding and learning. These are the hard times to hold your thoughts and keep you balanced in what you're looking for. Because when you trade for real and you're not just in a demo, okay, you're going to be out there making decisions on your own. And you want to know what those processes are because I don't every single day sit down and say, it's going to do this, it's going to do that, it's going to do this, it's going to do that. And you all see that. But the times I'm dialed in, we're really, really, really precise about what we do here. But I'm at that point where we have to wait for more information. And when that information comes, we're dialed in, and then we know what we're looking for. Just go back to the recent teaching and lessons in the last 3 weeks or so on my commentary for the dollar index and what that meant, what we were waiting for, specific conditions. I'm not giving you both sides of the marketplace and then flipping a coin and waiting and then say, see how smart I was. I'm waiting for a specific event to occur. When that event occurs, which I've explained to you before it happens, when they occur, then I know what side of the marketplace is going to be offered, okay, and what side of the market is going to be drawn to higher or lower. So just, again, as an example, when I say I'm waiting for more information, just look at the last couple of weeks in terms of the dollar index and how I've stripped it down. I gave you exactly what I do internally, and I told you how when I give you specific levels, how to use that for the unrealized dealing range. And it's the same thing every single week. I do that same thing every single week. So over time, you're going to learn to be able to do that stuff on your own. And when you sit down with these videos, you will already know what I'm going to say. And that's how you know you've arrived at least the level of understanding for weekly bias. Because everyone's asking, I see you calling it, I see you explaining it, and it works, but I can't get there yet. And that's part of why I do this every single week. You want to continuously see it being done. You want to see the periods like right now, the lesson I'm giving you today. These are the real critical lessons. There's no month where I do this like month 7 or month 6 or month 2 where there's a specific teaching. It can't be talked about in one lesson. It needs to be done on a week-by-week basis. And when we go into specific times of the year, like for instance, August, it can be a hit or miss type month. It can be really, really good when the market's offering something. But right now, I'm willing to be wrong with a 40% likelihood I'm wrong about long dollar still. But if a gun is held to my head and say, take a trade right now, I'm going to be focusing on shorting euro or cable. That's where I'm at right now. It doesn't mean that there's a setup to take, and every setup that would be forming bearish would be high probability. I'm just saying that if I were forced to give you my perspective right now, I'm still heavily weighted on long dollar. And I outlined this video, what would change that and what would shift me from not being so bullish to maybe contemplating that the dollar has formed a seasonal high for now. Just listen to the video. I said it in this one. Okay, so the COT data down here. All right, so when we pull up the charts, I guess I'll walk you through this real quick for folks that don't know. You're going to go to barchart.com. You're going to click on this little select commodity, scroll down to British pound. You're going to click on that, and it's going to offer you your delivery months and your cash market. Cash market's always going to be listed at the top, and it's always going to be the symbol, British pound, number 6, Y00. Every other offering in this listing is British pound. Q is August. You don't ever really want to look at that one. September is the next high open interest delivery month. So you have the symbol U for September for commodities. 19 is 2019, is what that represents, and September is the contract. Look over here, you can see the volume is the highest, and the open interest is 285,242 contracts. That means that's what's available right now for trading, or what's been traded rather. That's the open interest that's in the marketplace right now. Click on that. You're always going to be looking at the nearby month, or you can get the cash market. It's the same. Not in the same that it's going to look the same in the charts. It's going to be really close to it, but the prices will be slightly different. And once you get to this price point, well, listen to me. Once you get to this point in clicking on that link, you're going to go to interactive chart. It'll automatically pull up your British pound September delivery contract. And then if it's not already showing, you want to click here, change it to candlestick open to close. And I'm showing the last 3 years data. It may not open to that. And you can see down here there's no chart indicator. So what you're going to do is go to study, and you're going to scroll down to commitment of traders. Click on that. You want to see the red line. So everything else where it says a little eyeball for large specs, you don't need to see that, and you don't want to see small specs because they're clueless in the marketplace. Then click add, and then right away you'll have your commercials plotted down here. Now once we have this information, okay, I teach you how to use this information and how to construct or at least visualize the ICT commitment of traders or large traders or commercial traders hedging program. So here's May. Obviously every calendar in the world after May you have June and then July, which we just completed. So July, June, and that time period, if you go back to the previous year, which is right in here, okay, right about this time point, we're looking back. We want to get a range. Okay, what range low and what's the highest it's been. In other words, where the commercials have been. And then once we have these two price points, or reference points rather, on our COT data or net traders position chart, which is what this is, everything to the left here we don't care about, so we can forget about it. Okay, so I'll just use the charts here as a graphic depiction. And you can see that we're focusing on the range of the commercials, the highest high and the lowest low in their commercial trading and their positions. And once you have that range, you can divide that range in half, and that'll give you your midpoint. So everything that above it would be considered bullish, everything below it would be considered bearish. And then once you have that, you can visualize it like this. This is what it looks like for periods when it's bullish. You can see we entered an area where it's bullish, and we can anticipate bullish prices, which is what we were looking for. And then we saw a period of bearishness. Okay, and if you look above, you can see on the chart where the market did create an intermediate high, and the market started to break down, which we were bearish back then. And you can also see from a long-term trend standpoint, okay, go back to May of 2018, you can see that we had this high form, and then we've continuously broke down. In here, okay, in here we were waiting for more information for the dollar index, okay, and we got that information. We were looking for these lows back here, and we were targeting these relative equal lows. We got that as well. And now we're looking for the same scenario with these equal lows that we were talking about for these equal lows. Go back and watch the reviews, and you'll see that everything we're seeing about these equal lows back then, we're expecting the same thing here. So we're expecting price to reach down here. What liquidity would be resting below these equal lows over here? Large fund liquidity. Okay, large fund liquidity. So in here, without having all the lipstick on the chart, you can see that this is apparently a bearish scenario that you wouldn't relatively jump to as a conclusion, because here's the zero line, and if you study the traditional application of commitment traders reports, and even Larry Williams' first study that he gave on the COT data relative to commitment traders using his 1970 book, How I Made $1 Million Trading Commodities Last Year, this wouldn't be seen as bullish by his interpretation. The application of the hedging program concept that I teach you in the core content, it'll obviously map out everything that is shown you here in charts, how to create it and build it. But in here, we're extremely bearish, even though that the zero line, I think, would have tripped people up. In other words, for people that would just look at this, okay, they see this as, look how bullish the commercials are. Why is this going down? This is to you, Mark. Okay, the answer to your question is you have to determine what the commercials are doing. Okay, they were extremely bearish here, and that's the top of the marketplace. Okay, they were extremely bullish here in terms of the range between here and here. Did it make the market go higher? No, because everything about how the commercials hedge is an ebb and flow. And I'll give you an example about what that means. If we go up here and pull up the commitment of traders data. All right, and then now I'm going to add the large speculators back and just remove the small speculators because small speculators we're not interested in. Here is the original just single by itself commitment of traders. Then you have the green line, which is the large traders. These are large. When I say large fund traders, or if I say it's a run on liquidity, what liquidity is it going after? These folks here, the green line. Because you can see that everything that commercials do, and just think, for instance, a commercial for the British pound is the central bank. Okay? The central bank is providing the liquidity to be 100% the opposite or the counterparty to the large funds. As the large funds sell short, okay, the commercial or central bank is offering it to them. So they want to sell. How do they sell something they don't have? They borrow it. Who are they borrowing it from? The central bank. So to be a short seller in large funds, just like anybody else, if I want to sell something, I have to find a buyer. Well, that's what's happening here. They're pairing up everything. So as the commercials or the central bank offers the liquidity to sell short, large fund traders want to sell short, they want to be bearish. Okay, great. To do that, there has to be a counterparty to that short, and the liquidity is offered by the central bank. Until we get an extreme in the range, then the bank says, okay, it's done. You know, there's nothing else to happen. They put a top in the marketplace, and look what happens here. We have a lot of sideways consolidation. Yes, there's some movement in here, but it's really lackluster. Long, drawn-out period of just who knows what's going to happen. If you're just looking at it from a traditional COT data, commercials are heavily long. If you look at that and just say, okay, commercials are long because the red line is above the zero line here, that doesn't equate to being bullish and then holding on to long-term positions because of that. I lost lots and lots of real money doing that in the 90s. And I mean lots of money doing that. Because I watched a video by Larry Williams, I read a couple books by Larry Williams, and he said that commercials, when they're bullish, they're going to look like this, and they make the low in the marketplace. Sometimes. The times are when you combine certain things, which is what we talk about in the mega trade teaching in the core content later in the deliveries of all the 12 months. I don't know off the top of my head where that is. I don't recall what month it is, but it's in there. But we have a nice rally here. All of this bullishness on the commercials here aided this, but as it was rallying, see what's happening here? As price itself goes higher, the commercials are selling into that rally. But now go back in here. Here's the large funds. They're buying it until they get to right here. Something takes place. It changes gears. We know because of what I just showed you with the hedging program, showing you that this area here is actually bearish. This is bearish. And you can see that the large funds used a large trending model, long-term trending model, to get in sync with that, and they've been since selling short. If they're selling short, who provides the liquidity for that short position? The central bank, and that's why you see them going bullish. So it's not just simply that they're heavily net long and why is the market breaking down. It's the overall trend of what this market's been doing, and then using all of the diametrically opposed positions between these two camps, the professional central bank and the large funds, which are professionals too. But during the trends, these green traders, these large fund traders, they're apt to be right. That's why these large hedge funds do very well, because they generally are good at trend following. The commercials will top the market and they will bottom the market. The large traders don't do that, because many times you're going to see that the large traders are wrong at the highest point of bullishness and wrong at the lowest point of bearishness. And let's see, here we have the highest high, and they are holding their highest point of bullish view here in all this time here because they were net short all this time. Look at the time, how much they spent below the zero line here. They were net short the whole time this thing was going up until they got to here. Then they said, okay, well, maybe this thing's bullish. You can talk yourself into all kinds of trading ideas with the COT data, and it doesn't work just simply because they're above or below the zero line. You have to look at what the order flow is. In other words, if you look at these price points of low to high here, in between that, they're dead wrong. The long-term trend following hedge fund managers and stuff, they're wrong here on this. But if you internalize what took place in the commercials and use what I teach for 6 month, 1 month intervals and get the highest and lowest range for their particular net positions, you don't need to look at the green one then. Everything focuses all on this red line. And these are not important. The only thing that this really illustrates is that dance between the two. The central banks offering liquidity, and then the large funds are the counterparty to that. But generally, it's the large traders assuming positions, assuming risk, and where are they getting the commodity or the currency? Who owns the store for British pounds? The central bank. So that's why this red line graphically depicts 100%. Even the little wiggles in here matches perfectly. That would only happen if the central bank is the liquidity provider. Because think about it. To say it any other way, okay, if you think about the common explanation for how the markets trade, it's random. It's 100% random. That means everybody out there randomly are buying and selling. They have no idea what's going on. You know, they're all doing different systems. They're all doing different indicators. But yet, there's this perfect symmetry between these two people here, or two bodies of investors. The central bank themselves providing the liquidity, and the large funds themselves. This is the market. This is how all markets work. This group of traders and the central bank. That's it. That's the real answer to all the secret stuff. Okay, the secret interpretation of net trader position and commercials. But there's a lot to go through to understand how this dance equates to a order flow scenario where it creates the opportunity to go in the marketplace. As I illustrated this past couple weeks, I talked about how we were looking for cable, and finally, as we got it, it happened on a Friday. The liquidity started creating really good signatures for bearish order flow. Fair value gaps, and we went up and closed in some fair value gap on the previous Friday, and then we were looking for runs on liquidity for cable, and we got that. And the expansion really led to the downside here. Now, I know some of you that don't really keep good notes, and you think about what I say, the previous recording where I said I favored going short fiber or Euro USD before last Friday. In other words, last Wednesday, I was electing to use Euro because I felt the levels were more cleaner. And we were waiting for more information on cable. Well, we got the information intraday for cable on Friday, but I was still able to do the shorts on Eurodollar. I did get stopped out after taking 80 pips, but it still went back in and crushed it last week. So without sounding like I'm beating my chest, we have one guy in here, Mike. Okay, you like to hold me to the fire, and that's good. I appreciate that, but you use all the information I give, because it gives a real false impression on social media, which it's not always a salesman display out there on Twitter. I'm really speaking some good information to folks I know won't ever subscribe to the mentorship, and that's fine. They don't need to be here. If they can get what they're looking for in the free content, that's great. But I always try to be a measure of inspiration there and try to keep people focused on learning, and don't be focused on looking at retail indicators and other disciplines of trading, because I'm convinced 100% that anything outside of what I teach here is stupid. It's foolish to even consider it, and you really are guessing. And if it works, it's the same thing as when I got lucky for 9 months. It's just luck. And that's when it exists, when it's dumb luck. But I don't believe in good luck. This is dumb luck or bad luck. They're the only two lucks I believe in. All right, so I think I've said enough about that. We're going to look at the Eurodollar. And the only thing you got to change over here, see this B6U19. You're just going to change the B to a letter E. E6U19. Everything on the chart will change. to euro dollar. And again, this is the Euro futures chart. And here's the commercials chart, just plotting that singular. And then here it is overlaid with the large fund traders. Okay. Now, if you look at this weekly BISI, this is the opposite of what I said for the dollar index, which is this is a SIBI, sell side imbalance, buy side inefficiency. This is the opposite of that. This is a BISI, buy side imbalance, sell side inefficiency. What's missing in here? The delivery of price on the downside. We got some of that range here, okay, and didn't quite get down to the order block here. That's why I'm saying that 40% still, I think that this can come in here and close a little bit more. And then we do have a volume imbalance down here. There's no candle here, just a wick, no body or candle offered in that range. So that would be an area also. Takes us down into, well, let's just get to close. Like, that would be better. Close is 107.06. So just basically 107.10. Okay, 107.10. If we get through the order block here, and again, this is really forecasting way out. I think that if we give up last week's low and break below that, the euro will see some big, large candles on the downside, but it needs to break last week's low. And I think other than that, there really isn't too much to say about that except for we get into this here. Now, if you look at again, this net trader position, the commercials look like they're bullish if you use traditional interpretation of it. If you take the last 12 months basically here, okay, and here's the low end of the range and here's the high end of the range, okay, we would still be relatively bullish. But there isn't enough of a movement higher or lower for my liking. Whereas, I don't want to go back to the cable chart, but just rewind the video and you'll see there's a lot more movement for cable between the two traders here. It's too elongated, and it's a lot of elongated movement here. And I think it has to do with the Brexit. Okay, and Brexit, for whatever reason, it just can't get itself worked out. Nobody has an answer for it, and I'm not smart enough to suggest what it is that is a solution. And like I said, I don't know what the ramifications will be technically if you guys get out of the European Union or if you stay in the European Union. So I don't know. I get a lot of questions from folks in the UK. What's the market going to do if this or that? And I just don't know. This is all new for me. That level of interpretation and what happens in the price as a result of all that is completely alien to me. I don't know, and that's why I have a vested interest, obviously, because my favorite pair is British pound, and it's not very volatile. But euro, I think, will have large expansions in volatility if we break the low here relative to what we've seen in recent weeks. It's been really, really, really small ranges. Like this big range here, I think we'll start seeing some of those on the downside if we get below last week's low. All right? But in terms of the hedging program applied to this, it's not enough movement in here. Okay, so I don't lean on this tool here. And the question is going to be, if it looks like this, if there's not a lot of separation between the high and the low, what do you do with that? I don't use this tool then. I use it on other pairs to get a feel for it, which is kind of like what I did last week when I said that, we called cable lower, it went lower. It did a whole lot more volatility on the downside, and I said, okay, well, it moved, and dollar moved, so we'll see euro dollar want to catch up. So it's the sixth sister syndrome, okay, where even though I got stopped out on a small portion of the balance and it wasn't a loss, I had to go back in again to go short on euro. The assumption was it will try to catch up to what cable has done, which is break down, move lower. And I don't think, even though we have these equal lows here and we did trade below it, if we trade back severely above these equal lows and get back up in here and take out the mean threshold of this candle, last up close candle here before we went down, we'll just call 125 big figure. If we trade above 125 big figure we need to be paying attention to the likelihood of creating the low of the year on euro. As I said before, this is way too clean. This is way, way, way too clean. And maybe the new prime minister, will cause some kind of a visibility or solution. I don't know. Or maybe he doesn't. Whatever the outcome is, it causes volatility. And I want that volatility to come into the marketplace. And whatever we see in that will have the mirror effect, okay, in dollar, and that will support the movement in euro. Until we get that, then, it's going to be very small movements, incremental movements in euro. But I like this still to close in completely down into the bearish order block. If we get through that and dollar really starts to ramp up on the upside, the volume imbalance down here would be, I think, the long-term draw, which is also the mean threshold of the last two down close candles here before this movement up. The middle of that range is about at the same time would close this imbalance up. Okay, between this bullish candle and this bullish candle, that little pocket there, we treat that the same way as a gap. It's just we label it a volume imbalance because even though we do have the wick closing it, it wouldn't look like a gap to anyone else or any other style or discipline of analysis. And I think that's going to be it for the weekly perspective. Let's roll right over into our traditional Forex charts. All right, so here is our dollar chart on our demo. 98.40 was the level I was looking for. Go back and watch all the old videos. We traded it at, went a little bit higher than that, went to 98.67. I mentioned that if we get above these equal highs, we could probably see some significant rejection in here. Be mindful of that. We're seeing it now. There really isn't a whole lot of imbalance to speak of here. We do have this small little down close candle. I don't think that's going to be by any measure, any support. I think if we go back down to this high here, that would be a complete closure of that imbalance or fair value gap, and we can extend that in time. So we'll say 97.20, 97.15 could be, if we continuously erode, that would be the level I'd watch to see if we get a reaction at. Even if it trades there, we could probably get a day trade off of that. Intraday scalp, get like 20, 30 points. I think that would be an area to watch. Until then, what I'm looking for is, do we shake this off on this down close candle? Do we trade down to this candle here, find some support, and rally back through? If we rally back through, man, this is really bullish then. I mean, really bullish dollar. We could start looking at the likelihood of longer term 102, 104 on dollar. It depends on how we trade, if at all, above this high. So you see that the things that I'm waiting for, I'm weighing out certain scenarios. I'm not saying buy it and I'm waiting to see if it pans out and then see how smart it was. And I'm not saying sell a short and if it trades lower, see how smart it was. I don't know either scenario right now. I'm looking at certain facets of price action and telling you what I'm interpreting right now and what I would think about it when it trades at this level here, where we're trading at now. I'd like to see it not gap down on Sunday. I'd like to see it gap up. Then trade down, close the gap a little bit to Friday's close, and then make an attempt to rally. That's what I'd like to see happen. Otherwise, it's probably going to erode back down to as low as this low here. And that would take us into optimal trade entry right in here. Okay, so just be mindful that that could happen. And we also have a gap, maybe a bullish order block. There's a couple things inside here that could happen. But I liked the, if we are going to trade lower, I like this area in here down to the gap right here between these two candles. Now that gap may not exist on your feed. It doesn't make a difference because it's still the order block here, and you will have that on your chart. All right, so that's what I'm looking for the dollar. We're waiting to see basically what we get in terms of rollover into the new week at Sunday's open, how we trade at that open, and then with the absence of no real data this week on Wednesday and Thursday, I think it was, if memory serves correct, we didn't have any data on it to be released, or no news drivers, if you will. Those days, we want to see what price is doing there. Really studying dollar and euro and cable on those 2 days. moving on into Eurodollar, we see price work in that consolidation here, traded back up. Bearish order block, trades up into this level here, breaks down, fair value gap, trades up into it here, breaks down, fair value gap, trades up into it here, and then here's the FOMC, which you guys saw me call that live on a, well, not a live, but recording it live as it happened. I mentioned that we would see 110.90 give way. That was for free level students, but everything changes when you get here, and you would break that down into 10, 20, 30 expansion, and we broke through the big figure, which always allows for 40 pips. The low came in at 1063 or 64 on this candle here. Spent some time, rebalanced back to this price point, and then we had another rollover, creating the low of the week on Thursday's New York Open. Classic, classic, classic. What is the range? What's the true range in here? Because we're looking at it on an hourly chart across 2 weeks. Is it this high here to this low here? For the weekly range, yes. But what is the dealing range on this fractal? It's this one right here. So if we take this high to this low right here, so I'm having this low and this high frame the dealing range. Price goes back above. What's PO3? PO3, it's power 3. I added this on the fib, and I'll show you what this looks like, because I know you're already asking, what is those settings? Here's the levels. I'll just show you everything here. Okay. The week expansion, we were looking for it to trade lower. Why is this high, the dealing range high, and not over here? All we're doing is retracing back up inside of this swing high. So we cleared liquidity here, spent some time there ahead of FOMC day, and then we broke down, and there was the signal where you guys saw me short, and you also saw my time and date stamps for actual shorts and where I covered. And the cover down here, look at the low, 110.26 and 5 pipettes, so 110.26 and a half. And I got out at 110.28, and I messed up on my limit order trying to get 110.26 was the limit, but I wanted it to be 8, but I didn't wear my glasses. Like a lot of times when you see me tweet, I'll have a typo of some kind. It's because I'm I'm too unwilling to get up and go grab my glasses, which I can see them 90% of the time when I'm doing these things incorrectly. I'm like, okay, I got too many things to go through, and I'm doing so. I'm not walking around. I'll just send it now. I can do it without making a mistake, and then that's when I make a mistake. So I'm human. See that? But here's our high, and this is our low, and look what we done. We traded through these two levels, which is the 20 and the 30 level, or 20 to 30% of the range from this high to this low. What does that mean? To me, I feel that this right here warrants a little bit more upside. In other words, we may need to close this area a little bit more. May want to bump up into this range here. It may even want to come all the way back up to the equilibrium of the range from this low to this high, and that would be right up in here, taking us into the optimal trade entry. So we could also come up here and sweep these equal highs out. Sweep that out, and that would be really exciting to see it come all the way up there and then really break down. That would be classic. I mean, if I was running Eurodollar and delivering price, that's exactly what I would do. I would send this thing up on 2 big candles to run these equal highs, get everybody thinking, okay, this was the low, and it's not, and then reject it and smash it down, and everybody would get out of the way. They wouldn't even get in it short because they wouldn't be allowed to. It would be moving too fast, and it would be like deer in headlights. That's what I would personally do. And that's what I'm interpreting with these two levels here, why it would be like that. If we go over to cable and zoom in a little bit, I've done the same thing here. Okay, here's the weekly range. Here's the low and the weekly range here. We did the equilibrium price point. You saw that in last Wednesday's recording. We traded up into fair value gap, and then we saw it break down, creating the low of the week on Thursday here. And again, at New York Open, which is classic power 3 for the week. In other words, how the weekly range is formed. And then now watch what happens here. With the fib down to this level, only reason why I have it drawn out here is I want this level touched to create the low. And that's what's being drawn out here, but I want to show you these two levels here. So it's not that I'm anchoring it to anything over here. I'm just making sure I'm pulling it down to touch this low and the high on Monday. It trades right back to the 20 and the 30. This is your classic power 3. In other words, if we were expecting price to create a down candle, in my mind, the classic interpretation of what that would look like, or anticipating it rather, would look like this. Here's the open of whatever the time frame, and then closing near or at the low of the range. Okay? When we have Thursday, New York Open, and you learn more about this in the core content and also in charter member stuff, if we're bearish, we want to be selling short from the weekly open, preferably at it or higher. Weekly open is right here. Okay? We don't have to get that. All we need is the upper 1/3 of the projected weekly range. And we'll say it's basically that. Okay, so a high probability scenario would be to sell short in this area here, with the expectation that we're going to expand down. In this area of shaded area, from the open on Sunday to whatever we do, in this area, time-wise and date, is typically between Sunday's open and Wednesday's New York Open. Okay? 70% of the time when we're bearish, this 1/3 of the range and the high is formed by Tuesday's London Open. Here's Monday. It starts right off the bat, which is exactly what I said. Go back and look at the previous weekend recording on the 20, I think I did it on the 27th of July. I said that we would just roll right over and be heavy, not have any kind of return back to the fair value gap. I mentioned one up here. I said it could come up and rebalance, but then look for a sell-off. But I think personally it's going to be heavy and remain heavy and just roll right over. And that's exactly what we saw happen. All these boxes in here, go back and look at the weekly midweek review last Wednesday, and you'll see me outline all the business here, so I'm not going to talk about all that. But on Wednesday of this past week, we see price run up into the fair value gap, and here's the New York Open, fair value gap, and continuation lower. Expand down, trading down into our objectives for cable, and then creating the very low, which is here. This area right here, from the low of the candle. Now again, the idea I'm kind of like fleshing out in front of you is this represents the entire weekly range. So while this is all hourly candles, if we were to transfer this into, or basically just do this. Alright, and then I'm going to show you in open, high, low, close. We'll zoom in. Here it is here. Here's the open, the up move, and then down, and then closing near the low of the day, or in this case, the weekly range. This is how I internalize when I'm bearish. I want to see the open, on Sunday to some key level by Wednesday's New York Open. That's what I'm looking for. That's how I frame one shot, one kill, all those types of things for short-term trading. Now, with this idea of what the weekly range should look like, if we're opening up here and we're expecting, like I stated before, we would look for 123 as the initial objective. Okay, not the low of the week, Mike. Just the first objective. That helps us frame with the unrealized dealing range the key entry point that has high probability. And then that's what these boxes are. We strip that down, went into lower time frame, 15-minute time frame, and you can see that there's very clear fair value gaps in there you can trade off of, holding portions of it on all the way through the weekly range up to Thursday's New York Open, which is when time-wise the algorithm, IPTA, the interbank price delivery algorithm, the low of the range on the week, if it's bearish, most of the time, 70% of the time, will create the low in New York Open on Thursday. Don't take my word for it. Go back and look at your charts and see that it's there. Sometimes, not a lot, sometimes Friday will roll over and go lower. Most of the time it won't. What will happen generally is you create the low, so when Thursday closes, which is here, you want to draw your fib on the weekly range, project it down. Okay, and if you get that, what will happen is the 20 level and the 30 level in your fib, this is where price will want to gravitate to. So when I was on Twitter with you guys on Friday, I said, pull a 15-minute time frame up on cable and note the recent high and low on the 15-minute chart, and then watch how non-farm payroll attacks that liquidity. And also, I said, most everyone wants to sell short cable right now. And is that high probability? Not if you understand what I taught in terms of the weekly range, and that Thursday New York Open creates generally 70% of the time when it's bearish, that's the low of the week. And then Friday, everything starts getting squared. Positions are squared. Traders that have sold short for the week, they're taking their positions off because they don't want to hold the risk over the weekend. So the price will gravitate back up to as much as the 30% level. And you can see it hits it beautifully there. And we close in between the 30 and the 20. That's this close right here. So we're not closing on the low. This movement from the low up to this price point here, I have ways of determining that. And for people that have been in the mentorship for a while, you understand that this is the TGIF trade. Or this is the framework for TGIF. Thank God it's Friday. That's a Friday trade. So what I was hinting at is getting everybody thinking, what day are we at, without having to tell you. What do we normally expect to see happen? Even though when we're bearish, we expect this little movement from the low up to the close. That's a trade in there. So inside this area here, if we break that down, I'm going to leave these levels here. I'm going to scrunch this up a little bit so we can see that that is inside of the range of the daily movement of Friday. And I'm going to come up a little bit higher. It's not there. There it is. Right there is what I'm looking at to line up. And there we go, hitting it. Now I'm going to drop into a 15-minute time frame. Okay, and you can see, well, here's the low of the week. Price pulling up into the 20 and the 30 level on the fib. Strip this down in here. What do you see price-wise? Do you see anything that would be an order flow signature? Order block. Fair value gap, price trades down, hits the order block perfectly, 2 times, rallies away. Breaker, trades to the breaker, expands up, ultimately inside the 20 to 30 range. Liquidity rests here, and we don't really have any imbalances until we get to this area up here. And if we get follow through on the downside on dollar, and euro wants to roll over too and go a little bit lower, cable could pop up and close in this imbalance straight up to the bearish order block at 122.20 to 122.25. Okay, so that's what I'm looking at here, and that's the interpretation I have on price at the moment. How we open and how we trade on Monday sets the tone for all these things. I don't know. I have to wait and see what we're doing, which is the reason why I don't like to trade on Mondays. I can see what Monday does. How does Monday trade? Monday could see it trade up here, and that would be it, and I missed it. I'm okay. I'm not going to get on Twitter and complain and cry and say, oh, I suck. I missed this. I'm never getting it right. Don't ever do that. Don't do that in your journal. Don't do that on social media, because all you're doing is fueling toxic thinking. And your mind subconsciously will drag yourself right back to those negative feelings. When you get ready to take another trade in practice, you're going to think, oh man, this is going to happen again. What's going to happen again? I'm going to do something wrong, and I'm going to feel like a stupid idiot because it doesn't ever work for me, and I'm wasting my time. Why? Because you fueled that by writing down in your own words that you suck, that you are a loser. You're never going to get this. You always mess it up. Our subconscious really retains emotional things. That's why in your journal, you always give yourself the positive reinforcement. Tell yourself that you are proud of your ability to stick with the plan that you were trying to follow for that day. If you did something wrong, say, this didn't work out. I have noted the result of it. Next trade. By doing that, you remove the pain and the emotional effects of the negative side, and you emphasize all the positive. Now, notice what you're doing. You're not cheerleading yourself where you think you're right about everything. It's balanced. And you don't beat yourself up when you got it wrong. You're objective about it. That's how you frame an objective, balanced perspective, and your mindset is perfectly balanced to weigh risk, fear, and greed. Because those three pillars exactly are the only weapons that take you out of this game. If you master those three things, risk, fear, and greed, you will have the longevity to do very well in this. But everybody talks themselves out of this because of their tongue and how they think. So the member that's in your mouth, that little unruly member, okay, that tongue, no man can tame that, okay? You need to work extremely hard not to say negative things about your development, your results, and don't talk about other people's results. Don't even tell someone, good job. Don't do that. Because all you're doing is fueling them to anticipate or expect more of that. You don't want to do that. Don't pat people on the back and say, oh, good job. You don't do that. That's why I don't like to high five my students. Not because it looks disingenuous or that it looks like we're bragging, because it fuels an emotional stimuli that your body will seek every time. And then when you do a trade and you do it again and you do well, the first thing you're going to do is you're going to want to send a tweet to me or you're going to send an email to me and you want me to pat you on your back. You don't need ICT to commend you for a job well done. If you did the job right, you tell yourself that. Because I'm not going to always be around. Your children aren't going to have me in their corner. Their children's children aren't going to have me in their corner to give them that congratulation. You need to do this internally. It's not a team sport. It only feels like a team sport in here because I'm helping you. But in the real world, in the real market, if your money's on the other side of my trade, I'm taking it. Think about that. Okay, because that's the reality of all this. In the demo land and training and all that stuff, your money's safe from me. But if you put it in the marketplace and you do things wrong, it's mine. And I don't feel bad about it. You shouldn't feel bad about it. We both know going into this, the risks are there. But just don't fuel yourself with bad, negative thinking in your journal. Focus on the things you've done right. Congratulate yourself without too much cheerleading. No high sugar adjectives. And certainly no vinegar. You don't ever put negative, okay, or emphasizing the negative in your journal. You don't do that. Because you're going to go back to this journal and you're going to see examples where, like I'm outlining here, how it works over and over and over again. And the few times that it doesn't, you'll be able to weigh that out. So sometimes you may not get the idea that pans out that takes us up into this level. This is only a 50-minute chart. If we drop down into a 5-minute chart, more setup. Fair value gap in here. From this candle's high to this candle's open, very small one, trades down into it, rebalance to a bullish order block, expands on the upside. We have a fair value gap here, trades down to it. Does it go beyond it? Yes. Where's it trade into? The bullish order block. Where's your stop going to be? It needs to be below a swing low. It wouldn't be anywhere near here. It wouldn't got stopped out. We have nothing else in here. Yeah, nothing else in here. And after that, expands on the upside. So how could you use this information in the setup for TGIF? if you're looking at like fair value gaps down here, okay, we trade below this low here, which is all that's necessary, trading to that low. We get it here and here. You could have got that fill on the upside. We can take a fib. Here's our, if this is the setup we're going to be using, fair value gap. If we trade to that price point up to the 30 level, I'll do the 20 level in a second, but here's our unrealized dealing range, equilibrium. So your setup has to form between this low and the equilibrium price point. Okay, if we see a signal up here, it's lower probability. It can be there, but it's less likely to pan out. Your fair value gap, your bullish order block, your optimal trade entry, okay, those will be better from this price point and under to here. And every setup I just gave you was in that discount market. From this level down to your projected entry, this is a discount. This is where it's high probability for it to expand up. If we drop it down to the 20 level, which is here, it's really obviously equilibrium's here. It's still, we can get the fair value gap here, we can get the fair value gap here, and that's it. We missed a boat on everything else. Nothing else in here. But it allows you opportunity to expand and get range. Now, I probably went really fast with all that stuff, but trust me, we'll see a lot more of that. I introduced the unrealized dealing range last week, and I know a couple people have already emailed me. I don't understand the unrealized dealing range. You won't. I only talked about it just last week. Okay, think about how much time we've talked about fair value gaps. That's why you're here, to learn. Let me teach you, but it's going to be on my pace, not yours. I'm not going to cut corners for people. Everything is delivered the same way. Through the lessons, when it's applicable with real examples, you can see it. It's not contrived. It's not the bones about what it is. And I'll show you with many examples and more insights as we go. Just trust the process. There's so many other things. If you send me emails about questioning something I just introduced, 90% of the time I'm going to tell you, wait for more information, wait for more lessons. So to avoid all that frustration and clogging up the email, okay, it's just better to submit like I promised you all you would have to do when you joined, okay? So I think that's going to be it. I just want to take a real quick look. I have not looked at dollar CAD, so I want to do that now. Daily. Reached up into mitigation block. Fair value has been filled in. If we see dollar index erode a little bit more, we could see this area here be a factor next week. In here, looks really heavy. It's like it just reached up in there, reached up in there, reached up in there, closed us in. If this thing really takes off on the downside, we don't have. Well, we have relative equal lows here. So assuming that we made a high in the dollar index, okay, say that's what we did, and I don't know that yet, and I'll tell you when I see it, but these equal lows here are highly suspect, and if we get to that price point and trade lower, I want you to look at this. Because after these lows are taken out, if we get there, I'm not saying that we are, I'm saying if we break down to this level and continue, this will be your next discount array, and then look at this area right in here. Okay, we have a gap. Price traded up through it with buy side delivery, so this becomes a BISI. Even though we have a weak, we have a wick in here, trading right in here. Let me zoom in. We have a wick in here, trading back down here too, almost closing in. We do not have a down candle in this shaded area. We don't have it. There's no body of down. And I think that would be an area to look at should we see this thing sell off even more. I don't know for certain right now if that's going to happen because I want to see how we trade on Sunday. But if we get some further downside on dollar index, there's a really obvious sell side liquidity pool resting below this level here. And if we trade through the order block, which I think if we trade below here, that would be the catalyst for a move below these equal lows. I don't think we would see this as an order block as a buy and then going higher. Why? Because we have equal lows here, and it's so close in proximity. This would be an easy run on liquidity. Even if they just take it down below these and then reject it and not get down to here, that would be fine. That would be something I would expect. I don't think that the run below this low here, like we've seen here, is a justified low. And I think that's probably what we've done here. We just pushed up, pushed up, pushed up. The down close candle right before this move up in here. This is mitigation. So we traded back up into the mitigation of this candle in here. Let me put the low here. Alright, so that's that. And we hit that beautifully. Down close candle right for that move. Mitigated perfectly, so we'll see if we get some kind of expansion. If we trade higher than this, then, well, then we probably had created some kind of a low here. It just looks really sloppy. To me, it looks like we've traded softer, retraced, and there's going to be another round of selling, and maybe even get down to this level here. Not right away, but I think that that would be the intermediate term draw on liquidity. And assuming, again, if dollar index is extremely bearish and rolls forward, breaking down into this area here. Okay, so that, my friends, is going to be it. Have yourself a very pleasant weekend. Be safe, and I will talk with you all by way of the forum next week.